Morning, everyone. Thank you for your kind messages. Just hang with me until I get the documents sorted out. So today is the 7th of April. So today, actually we are a little bit ahead of time, aren't we? Prof, we finished last week the consolidated and separate financial statements and accounting policies, estimates and errors. So we covered some of last week's work this week, which is good. That gives me a little bit more time.
Yeah, we are going a little bit ahead.
Yeah, that's good. So today we are going to do basic financial instruments and other financial instruments. So I'm going to cover those two together, and then we'll take it from there. Let me just get the document up and running. Right, here we go. Okay. Right, let's get started. I'm just going to share my screen now. Right, can you see my screen?
Yes.
Great. Okay, I'm just going to now record the session as well. Record to the cloud. Okay, so thank you once again for coming to the course in IFRS for SMEs. So today I'm going to cover financial instruments. Okay, very quickly, section 11 and section 12 or other financial instruments issues together deal with recognizing, derecognizing, measuring and disclosures of financial instruments. Okay. Now, how many of you are familiar with what a financial instrument is? Anyone? Come on. What is a financial instrument? Very simple terms. Come on. Somebody tell me, what do you think is a financial instrument?
To measure status.
Sorry? Can you repeat that?
So
what did you say?
monetary contract between two parties.
It is a type of a monetary agreement, monetary contract, a monetary legal binding situation between two parties. That is correct. So that is a financial instrument. So it is like any other asset. It could be a part or complete. Okay. So section 11 applies to basic financial instruments and relevant to all entities. Section 12 applies to other financial, more complex financial instruments and transactions. We'll also cover that today. So if an entity enters into only a basic financial instrument transaction, then section 12 is not applicable. Okay. So you need to have a basic understanding of section 11 and 12. Accounting policy choice. The entity shall choose to apply either a requirement of both section 11 and 12 in full or the recognition and measurement requirements as opposed to IAS, financial instruments, recognition and measurement and disclosure requirements of section 11 and 12. Okay. So basically, can you give me a couple of examples of financial instruments that you're aware of? A futures contract, for example, is a financial instrument. Derivatives is a financial instrument. Okay, right. So let's go through section 11 in a little bit more detail. So financial instrument is a contract that gives rise to financial asset of one entity and a financial liability or equity instrument for another entity. So in other words, you remember that first video I showed you with my friend going through all the details of the balance sheet, right? So when there is an asset, there is either a liability or equity, right? There has to be a balance in the scale. Is that clear? Why is there no interactions? I don't like to be talking to a screen and no interactions, because then it's not fun. I need people to talk. Okay. So can you remember the one I asked you about, the scale, where you had to, if you put something on one side of the equation, you must add something on the other side. Can you remember that? Financial instrument gives rise to an asset. There has to be an equal and opposite reaction on the other side. So how can you finance a financial instrument? That is my question. How can you finance a financial instrument? Anyone?
With discounting with banks.
So what if you get it from a bank, what would that be? A liability or equity? If you borrow from a bank, is that a liability or an equity?
Liability.
Liability. So if that is the case, then it's a liability. But if it's if you give ownership of that asset, it could lead to something different. It could be equity for one company. Okay. Right. So financial instrument is a contract that gives rise to financial assets or one entity and a financial liability or equity instrument of another entity. Okay. So do you understand this particular section 11.3, what it really means? If it's not clear, I can go through it again, because fundamentals are very important. Once you know the fundamental, we can move forward. Any questions there? Yes or no?
No, sir.
No. Okay. Anyone else? Any questions? Okay. Section 11 requires amortized cost model for all basic instruments except the investment of non-convertible preference shares and non-putable ordinary or preference shares. In other words, we can talk about it generally as shares, publicly traded or whose fair value can otherwise be measured reliably without undue cost or efforts. Okay. So basic financial instruments, which is scope of section 11, are those that satisfy the condition of paragraph 11.8. We will look at it soon. Examples of financial instruments that normally satisfy this basic instrument are cash, and here are some of the other ones. Here you have here the whole list of them. Demand and fixed term deposits, commercial papers and commercial bills held, for example, like treasury bonds and things like that. Accounts, notes, loan receivables and payables, bonds, similar debt instruments, instruments in non-convertible preference shares and non-putable ordinary shares, commitment to receive loan if the commitment cannot be net settled in cash, and so forth. So there are different ways or different types of basic financial instruments. Okay. Examples for financial instruments that do not normally satisfy the condition of paragraph 11.8 and those that fall under section 12 are asset-backed securities, such as collateral mortgages. So example, my mortgage is an advanced instrument. So in other words, I own my house, but my house is also mortgaged to pay off. So until I pay off the mortgage, the house is not fully mine, though it is legally mine, subject to paying off the loan. Okay. Options, rights, warranty, future contracts, financial instruments such as designated as hedging instruments, then there are a commitment to make loans to another entity. For example, if you sign as a guarantor, then that becomes a complex financial instrument. So let's quickly look at a video which I prepared for you. Let me see if I can find it. Bear with me. Okay, you should be able to see this.
Hello and welcome. Today we will be providing a brief introduction to financial derivatives. This video is intended only to provide a general picture of what derivatives are. The four most common types of derivatives will be examined in greater detail in standalone videos in the coming weeks. So what exactly is a financial derivative? Well, in its most general sense, a derivative is a contract whose value is based on something else. But more specifically, the term financial derivative refers to any security whose value is determined by or derived from the value of another asset. The asset from which a derivative gets its value is known as the underlying asset, or simply underlying. An underlying asset can take many forms, but it commonly refers to stocks, bonds, commodities, currencies, interest rates, and market indexes. The most important thing to take away from our discussion of derivatives so far is that their value depends upon the value of something else, the underlying asset. So, the change in the value of a derivative's underlying causes a change in the value of the derivative itself. This is all well and good, but what's the point of derivatives? Well, there are two main uses for derivatives. The first is to hedge risk. Derivative hedging generally refers to the practice of using derivatives for the objective of minimizing risk in the physical market. In order to demonstrate how a derivative can be used to hedge risk, consider the example of wheat producers and cereal manufacturers hedging their exposure to fluctuations in wheat prices. As we know, wheat is susceptible to significant fluctuations in price, owing to both supply and demand. A fall in the price of wheat is bad for wheat producers because they can get less money for their crops, but is good for cereal manufacturers because they can get one of their key inputs at a discount. On the other hand, an increase in the price of wheat is good for wheat producers because they can get more money for their crops, but is bad for cereal manufacturers because it increases costs. So, it is in the interest of wheat farmers that the price of wheat remains high, but it is in the interest of cereal manufacturers that the price of wheat remains low. Now, if a wheat producer expects that the price of wheat is about to fall, and a cereal manufacturer is of the opinion that the price of wheat is about to rise, the two parties can enter into a contract fixing the future price at which the wheat will be sold. For example, a wheat producer might agree to sell wheat to a manufacturer in 6 months at the current market price of $12, regardless of what the market price for wheat is in 6 months. By locking in the price of wheat, the producer is seeking to protect his or herself against an expected decrease in the price of wheat. On the other hand, the manufacturer is seeking to protect his or herself from an expected increase in the price of wheat. If the price of wheat falls, the cereal manufacturer or buyer will wish that they hadn't signed the contract, because they could be buying wheat for cheaper had they not signed it. Conversely, if the price of wheat rises, the producer or seller will wish that they hadn't signed the contract, because they could be selling wheat for more money had they not agreed to the contract's terms. Because the price of wheat can only move in two directions, up or down, this example is a zero-sum game, possessing both a distinct winner and a distinct loser. Basically, the interests of only the wheat producer or the cereal manufacturer can be met, not both. So, in this example, a forward contract was used by both wheat sellers and wheat buyers in an effort to hedge price risk by locking in the price of wheat. We will discuss forward contracts in greater detail in another video, but what is most important to take away from this example is that derivatives can be used to hedge risk. The second main use of derivatives is speculation. Derivative speculation is fundamentally different from derivative hedging. Where derivative hedgers are trying to reduce their risk exposure and usually are not motivated by profit in the derivative market itself, derivative speculators are motivated purely by profit seeking. Basically, hedgers seek to limit risk by using derivatives as insurance policies, while speculators are directly driven by the opportunity for profit. Now that we have a basic understanding of how derivatives are used, let's take a look at the different types. There are four main types of derivatives: forwards, futures, options, and swaps. Each of these concepts will be addressed in greater depth in future videos. Here our aim is only to provide a basic overview. With this in mind, let's begin with forward contracts. A forward is a customized contract between two parties to buy or sell an asset at a specified price at a specified future date. Forwards are not traded on a central exchange, and as a result, they are not standardized or regulated, making them particularly useful for hedging. Futures contracts are fundamentally similar to forwards. However, unlike forwards, they are standardized and regulated so that they may be traded on a futures exchange. Futures are often used to speculate on commodities. An options contract is a contract that gives the right, but not the obligation, to buy, call, or sell, put, a security or other financial asset. Finally, a swap is fairly self-explanatory and refers to the exchange of one security for another based on different factors. So we have seen that derivatives are contracts whose value is based on something else. We have seen that they can be used for either hedging or speculating, and we have briefly touched on the four main types. This brings our overview of financial derivatives to a close, but please stay tuned for our...
Okay. Now, how was that? Do you now have a basic understanding of what an advanced security is like? Is it clear? Yes or no? Sorry? Why is this class very quiet? Why aren't you all participating? Because let me just, Prof, I'm just going to deviate a little bit, okay?
Yes, Prof. Students, please interact, Prof.
Because the problem is, if you are not going to be... Now, before we go forward, I also want to ask you, how many of you can remember the subprime crisis that happened because of very complex financial instruments back in 2007, 2008? It was the worst financial crisis that the world has ever seen. How many of you have heard of the 2008-9 financial crisis? Raise your hand using your computer. You can either raise your hand physically or you can raise your hand on the chat engine. So we have, most of you have heard of it. Good. Do you understand what it is? Do you know what the financial crisis was and how it was created? Do you understand?
Giving bad rating.
No, that wasn't the reason alone. No, that wasn't the reason. Okay.
So
I'll tell you what.
default on the mortgage.
Default on the mortgage, but how did that happen? So there's a nice story behind it. We'll look at that a little bit later, but let's finish what we are supposed to cover today. And then we look at this as a story to support what we are talking about today. Okay. Now, Section 11, as we said, applies to all financial instruments meeting the conditions of paragraph 11.8. So that will be the one up here. This is 11.8. So basic financial instruments. Okay. We'll refer to that again very soon, but we'll quickly go through this. Okay. So investments in the conditions of paragraph 11.8, except for the following: investments in subsidiaries, financial instruments that meet the definition of own equity, leases, employers' rights and obligations, financial instruments, contracts and obligations under share-based payment transactions, are all exempt from this Section 11 application. Okay. So what we call basic financial instruments are cash, debt instruments such as account, note of loan, receivables, commitment or to receive a loan that cannot be settled net in cash. And when the commitment is executed, I think we looked at this all earlier as well, but I'm just going to go through it again just for memory. An investment in non-convertible preference shares and non-putable shares and so forth. Okay. Now, a debt instrument that satisfies all the conditions shall be accounted for in accordance in section 11. However, if there are complex ones, we have to deal with the section 12 of the standard. Okay. Now, I don't expect you to know all these standards by heart. So don't worry too much. What I need you to have a basic understanding so that if the time comes in applying, you go and learn yourself and you can apply it at a later date if you're planning to be an accountant in the future. Now, Prof, just to get an idea, are these all accountants or are they from mixed disciplines?
They are from different disciplines.
Okay, that's perfect. That's perfect. So
basic understanding about the standards are enough, Prof.
Yeah, correct. Okay.
So that recognition, measurement, presentation, and disclosure, basics they should be knowing.
Okay. No worries, Prof. Right. So let's say a debt instrument that satisfies all of the conditions A to D shall be accounted for in accordance with section 11. Okay. So I'm not going to go into detail with each of the specifics because again, this is an overview. An example of debt instrument that would normally satisfy the conditions in paragraph 11.9 include a bank loan that has fixed interest rates, bank loans with interest payable at a quoted or observable variable rate and so forth. Other examples of financial instruments that would normally satisfy the criteria are trade accounts, notes. Do you understand what a trade account is? What is a trade account?
No, Professor. Can you, somebody respond, please? Bills, receivables, trade credit.
What is trade credit? I want to understand if you understand the term trade credit. Anyone?
Letter of credit, that one, sir?
Not necessarily a letter of credit. No, it's not.
Anyone else? We'll get accounting class. Yeah.
So whenever purchasing some raw materials kind of material, the sellers will give them some credit period.
That's right. Perfect. So trade credit is where you buy from someone and the supplier gives you a credit, usually 30, 60 or 90-day credit. So these are what you call trade credits. Okay, very good. Thank you for that. Right. Then you're talking about, where were we? Trade accounts and notes, receivables, payables, loans from banks. Your credit card loans, for example, is a similar example. Loan to or from subsidiary to associates that are due on demand, etc. So you have all these different types of simple instruments. Okay. Now let's look at the recognition criteria of financial assets and liabilities. So when you're recognizing these instruments, the same definition and recognition criteria that we discussed applies. So that's why I say basics are important. Everything is built on basics. Now you remember the definition and the recognition criteria, I hope. Yes? Can you remember the definition criteria and the recognition criteria? Just a simple yes or no is enough.
Students,
one of them you mentioned, reliability of measurement. What is the second one?
Fair value and historical value recognition.
No, that's reliability of measurement is one of them. I already mentioned that. What is the second one? Probability
the
of the probability of occurrence. The probability of occurrence. Inflow of, we already talk about future economic benefit based on past transaction that is under the control of the entity. That is the definition criteria. I'm now talking about the recognition criteria. Now, Prof, I want an exam question around this if you don't mind, because they need to know. These are basics when it comes to financial IFRS, these two areas is an absolute must.
Yes, Prof. Last week we had the first internal test. I asked these questions. What are the criteria
All right, so
for
they should be knowing
recognizing-
this. They should be knowing this. They are not answering well enough.
They are writing open book exam, so they must be knowing it. Maybe they will be referring the book again. This
Okay.
particular batch is having that advantage.
Right. Okay. That's not good because they need to know this
Yeah.
very clearly.
They
Okay.
should
All
have
right.
it in fingertips.
Correct. These are simple things. Okay. Right. So an entity shall recognize a financial asset or a financial liability only when the entity becomes party to the contract provision of the instrument. That is very important. So you can only recognize it when you are a party to that instrument. Obviously, to be a party to that instrument, you have to satisfy the definition and recognition criteria anyway. Okay. Right. Next we have they talk about the initial measurements and so forth. I'm not going to go through in great detail on the measurements, the original measurements, but I would like you to read through this section and be familiar with it. You don't need to know it in great detail, okay? They've given a couple of examples here. Impairment of financial assets measured at cost or amortized cost, etc. So amortization, what do you mean by amortization or depreciation? What does that mean? What is the difference between amortization and depreciation? Depreciation relates to an asset that is declining through wear and tear. Amortization is for a acquired intangible asset where we reduce it over a period of time. Yes?
Can you recall
Yes,
the
sir.
different terms we use for depreciation for different assets? They learned in accounting.
Okay. I'm not going to go through this because it's not an accounting course. I'm not going to go through it in detail. You better know those things. It's very important. Okay.
Yes.
Right. This is an important thing. What is fair value? Can somebody tell me what the fair value is? Prof, you remember the example I used when I was in Pondicherry? I used my phone. I took my phone out and I said, look, how much are you going to pay for my phone? Yeah.
Yes.
Very good, Prof. Yeah. Can you remember, Habib? You were there, right? Yes.
Perfect.
So what is fair value? Let's do the same exercise, okay? So I have a phone here. Here's a phone. Sorry, you can't see this because of the video. Okay, hold on. Let me just get rid of the filter because I don't think you can see. Okay, can you see this phone?
Yes, sir.
Right. It's a Galaxy S10. Okay. How much are you going to pay me for this? If I'm selling it to you right now, how much are you going to sell this for me?
The amount which satisfies both the parties.
So you tell me, how much are you going to pay me? You write it in the chat box. How much you're willing to pay?
Definitely lower than the original value.
Sorry.
Definitely lower than the original value.
Yeah. How much are you going to pay me? I know it's going to be lower than the original value, but how much are you going to pay me?
How long did you have the phone, sir?
I had it for 1 year and 7 months.
How much
And
you
what
paid
was
for
the
that?
initial price, sir?
The rate
Initial price was, let me see, $1,600. So that will be, how much is that? How much is in Indian rupees?
it is around 71,000, sir.
INR to AUD. Let me just check now.
It is 71,000 INR, sir.
Okay, let's say 1,500 to just to keep it easy. 1,500 would be 84,000 INR. Okay. So how much are you going to pay me for this now?
45.
So one person is 45. Anyone else?
40.
40. Anyone else? Yes, the phone again. Anyone else? So put some values that you think you are happy to pay me on the chat. So somebody is offering me 71,000. Oh my God. 40,000, 35,000, 30,000, 45,000, 40,000. Anyone else? Any other offers? Now I'm going to ask you another question. So there are all these different figures. So how much would I consider a real fair value to be?
40.
60.
Why? What is your, how do you come up with that figure?
So what I did, you told I considered the price as 75,000, and I searched in the internet about depreciation of phone. It is 15%, and I tried to find the present value after 1.5 year of uses. So it is
Okay.
giving me somewhere
So
around 60,000.
you had some kind of formula, but can somebody tell me if the fair value is also zero to some people? Can the fair value be zero?
No.
Why not? How many of you have your own phones? How many of you have your own phones?
Almost everyone, sir.
Everyone.
So would you actually really need my phone if you have one?
Why not a better one?
Okay, maybe a little bit better. Okay, fair enough. But would you pay what and how much you're willing to pay, and whether the transaction is real or not would determine the fair value. So determining fair value is a very difficult and tricky task, because what is considered as fair value will depend on different market conditions, demand, and so forth. So all these things play a key role. So that's why I said fair value is a very difficult technique in an active market. Now in Australia, I can sell this phone for about $300 to $400. That will be about 22,000 to 24,000 INR. So you are already overpaying me by about 8,000 INR. Your most minimum offer was, I think, 25,000. Somebody said 25. No, it wasn't. The minimum offer is 30. So you're still overpaying me. Yeah. So you have to be very thorough with market.
You have used only for 1 year.
So one and a half year.
You have used only for 1 year.
1.5 years, I have. Not 1 year.
Yes. But how can you sell it for less than?
But that's
Like
the market
less than
in
off
Australia.
value.
If I try to sell this now in Australia, it's going to cost me, I can only get about $300 to $400 out of it. So almost one third only. So you see
But
the
it will be
market
benefited
conditions
only
differ.
to the
If I
person.
take this to my home country in Sri Lanka, I can sell it for about 50,000 INR. So you see, the country also plays a key role. What do you mean by country? The socio-political position, the socio-economic conditions all feed into the valuation of financial instruments and how financial instruments work. So my point is that when you're talking about financial instruments, you must also not look at it in isolation. Financial instruments also needs to be looked at from the greater economic perspective. Is that clear? Sorry? Very clear? Yes or no?
Yes,
okay.
sir.
Good. Okay, now let's see if I can put a quick... Can you put mute if you are having any other discussions on the side, please?
Agrima, can you please mute yourself? Yes, Prof.
Okay, now I'm just going to quickly play a video of what caused the global financial crisis, okay? Because it's important, because global financial crisis happened because of derivatives and financial instruments, okay, and so forth. So we need to understand how financial instruments played a key role in this big issue, okay? Now I'm going to quickly share another video with you. Let me see, how do I do it? There we go. All right. Can you all see that?
The crisis of credit, visualized. What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But in the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO.
So just to put it into context, the CDO is a complex financial instrument. So what happened here is that these bankers created these different complex financial instruments, which a lot of people didn't understand the gravity or the seriousness of it. And then that is the one that caused problems. Okay, let's continue that here.
A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in and the bottom tray may not get filled. This makes the bottom tray riskier and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice as a safe, AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered if the homeowners default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages.
So that's where this term subprime mortgage crisis comes from. Subprime is referring to people who are not entirely financially secure, don't have evidence of financial security and so forth. Okay, so they are called subprime mortgages or the subprime market. So that is where this issue of the subprime market came up. Okay, so keep that in mind and let's move on.
This is the turning point. So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone and makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy the investor to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bomb. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bomb, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bombs. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
What do you think of that video? Do you now have a better understanding of what you did earlier in terms of financial instruments and how financial instruments in the subprime crisis played such a dangerous and catastrophic role in where it has come?
Yes, sir.
Yes, sir.
Yes? Good. Brilliant. Brilliant. Okay. Now I'm going to again share the screen with you of the document. So again, valuation techniques, you don't have to worry too much about the valuation techniques in terms of how things are valued. That is usually done by an expert valuer. So a valuer will come in, use, they are called quantity surveyors or valuers. They will come through, they will go through your property and they will put a value on your house. Okay. So it is interesting that I had a house earlier. It had 3 different values when I took a valuation in the last 10 years. Okay. So once it was valued at, let's say, 10,000 rupees, then a couple of years after that at 12,000 rupees, and then 8,000 rupees, and then 15,000 rupees. I'm just giving a hypothetical figure. Okay. So all these things have different values sometimes, and they can be different based on perceptions, market conditions, and so forth. Okay. Let's look at other financial instruments very quickly. So other financial instruments are instruments that do not fall under the first category. So everything that we talked about now that we watched on the video are other financial instruments or complex financial instruments. Okay. So again, these things are exempt from financial instruments that fall under this category. So some examples of financial instruments, we can talk about the mortgages is a type of, or the subprime, the CDOs are considered as advanced instruments, financial instruments. Okay. So Section 12 applies financial instruments that are not covered here, which are covered under Section 11. Financial instruments that meet the definition of entities' own equity are excluded. So these are the exclusions from what we talked about under section 12. Okay. Most contracts to buy or sell a non-financial item such as commodity, inventory, or property, plant, and equipment are excluded from this section as well. In addition, the contracts described in section 12.4. This section applies to contracts to buy or sell non-financial items if the contract can be settled net in cash. Okay. So let's go on to some of the impairments and so forth, hedging accounts and so forth. So, okay. Again, I'm not going to go into a lot of detail of financial instruments because you will probably do it in a specialist financial unit anyway. Okay. But what I want to highlight is that the importance of understanding the differences of financial instruments, hedging or fixed rate interest rates, for example, are some examples of hedging contracts. So, how many of you believe in going in a fixed rate home loan? Raise your hand. How many of you think fixed rate home loans are good?
I would, sir. I would.
Why is that?
Because there is no risk here, and there is no risk in the forthcoming months or to pay. That's why
You're forgetting that it depends on the market. I'll give you an example. A good friend of mine fixed his home loan rate when it was going down. He thought 3.1 was a fantastic figure because it was at 6% earlier. It came to 5, came to 4. Then when it came to 3.9, he waited till it came to 3.1 and then he fixed his rate up for 3 years.
Yes, sir,
Do you know how much I'm paying? Do you know how much I am paying? 2%. So who's better off? Him or me? I'm on a fully variable loan. Let me explain to you one thing. If you look at it from a grand scheme of things, you neither lose nor win. So if you remember the first video I showed you, it said it's a zero-sum game. There is a clear winner. I disagree with that because if you look at it in the long term, and if you fix up the value in a way that it's always in the midpoint of market going up and market going down, if you keep the midpoint straight, then nobody loses and nobody wins. But the market and the people in the market are too greedy to look at it in the long-term perspective. And that is where integrated thinking and reporting comes in. Integrated thinking and reporting talks about the short, medium, and long-term. So that is where the importance is. So I'm trying to change your minds not to be short-termists. In other words, don't think about the short gain. Think about the long haul, where everybody will benefit and everybody gets rich. So the subprime crisis happened because everybody wanted to make a buck for themselves without thinking the entire thing. Just imagine, if you are the only survivor in the market, it is useless because you're not going to get any benefit. So that is where our culture, our systems, in other words, when I'm talking about our culture, I'm talking about the Asian culture. I'm from Sri Lanka. So we have the culture of looking at things from a communal point of view. We care about the community. We work as a team, where we have generations of people living under the same roof. Grandparents, parents, kids, uncles, aunties. Yes or no? So that is where we are in a better position than the Western culture, where the Western culture's success is measured from the car you drive, whether you have a Ferrari, whether you have a mansion. That is not important. What is important is that everybody does well. If everybody does well, you do well. Keep that in mind. And it's 2 o'clock, so I have to bring this to the close. But I'm happy to answer any questions if you have any. I'm going to stop record now.
Why investment banking itself can buy that risky mortgages, sir?
Sorry, can you ask that question again?
In case of 2008 crisis, why the
Yes.
investment banking itself can buy that risky mortgages?
They did it because they were silly. They just wanted to get some money. They wanted to, because it was paying 10% as opposed to 7% or 4%, they got greedy. And they went and bought all these risky investments. Can I ask you a quick question? How do you measure your success? Now, Professor Charumathi, you come to my home when you are here. I don't live in a mansion. I live in a simple home, but it is good enough, right?
Yes.
You don't need to live in a mansion. You don't need to earn millions of rupees to be happy. Keep that in mind. Okay. Any other questions? Does my answer address your question? Whoever asked that question earlier about the lenders?
Yeah.
Is the ratings given by that institutions are good, sir? Morgan Stanley and all. The AAA.
No. It is a guesstimate. You can't be 100% foolproof. They are based on assumptions. If the assumptions remain the same, they are valid. If the assumptions change, then they are not valid. So it's not the rating that I'll be worried about. It is what is the underlying assumption for that rating. Does that make sense?
And still now rating methodology is a black box.
It is flawed. Absolutely.
Yeah.
Yes, sir.
Yes.
Yeah, like Shyam was asking about the ratings of AAA bonds. So
Yes.
like I like to give a small information about it. Like even some hedge funds they shorted the AAA bonds also during that subprime crisis.
Yes.
They thought that those are like bogus ratings, and hedge funds started shorting these AAA rate bonds also.
Yes. They'll do anything to make a buck, right?
Yes, I also heard that news. JP Morgan and Goldman Sachs are buying some aluminium and increase that share price like that.
Artificially increasing share price. Yes. They will play all sorts of games. So the thing is that we must be very careful not to fall into the trap of looking at this. Look, if you are sufficiently earning enough money to live a good life, isn't that enough?
Yeah. Yes.
Exactly. I really enjoyed my month when I was in Pondicherry. It was a very simple lifestyle. I really enjoyed it. I really enjoyed staying. I stayed at your, what was the place called, Prof? That
guest house.
Guest house. Yes.
Pondicherry.
So I was there. I went with Habib many times to those food outlets on in front of your university. There was one place we went, a couple of places we went there, that ice cream shop as well. Habib? Yes. So we went to all these different places, and I went to some of the other hotels. Professor Charumathi also took me around. So it's a wonderful town that you live in. Enjoy that life. Very beautiful town. Enjoy that. You have a lot of beauty and a lot of peace. The people are very friendly. People are very good. That is more worth than money. It is better than some other countries.
Yeah, Prof, people from Pondicherry never like to move outside, Prof. Even
I'm not surprised. I'm not surprised.
Who take MBA from university also,
yes,
seldom they move outside. They don't want.
That's very good. Very good.
Remain in the town.
Excellent. Okay, if there's no other questions, are there any other questions? I can give you a little bit more time if you have any questions.
Sir, I have a question, sir.
Yes, please.
Sir, in India, if you see the economic condition, there are more non-performing assets in the banking sector, sir, if you see. So many banks are now merging. If you see example, many banks are merging now. So as a prudent person, if I go to home loan or some other loan, I wouldn't take risk as of now. If you see the economic condition of India, as a person, as a prudent person, I just don't want to take any risk in any loans. So that's why I told and I quoted that I don't want to take risk in these loans, sir. This,
So I always advise you need to have at least one property, meaning the home you live in. It's always worthwhile to have that as your own. In that context, if you look at it as a 20 to 30 year investment, then I would say go with the market. I don't believe in fixed rate mortgages. I believe in variable because variable rates
but
are
if the
risky.
economic conditions are poor, how can I afford to take a risk, sir?
You only take a risk to what you can afford. In other words, if you're going to pay rent of about 10,000 rupees a month, you buy a mortgage or you get a house that will also use the similar or close to that amount that you will pay as rent. Do you understand?
Yeah. Okay, sir.
So in that context, you are not risking too much. So if you have to pay rent per month to live in, wouldn't you better off paying it towards yourself than someone else?
Sure, I would, sir. But if you see the interest rate of HDFC in our Country Housing Development Finance Corporation, it is 7% for home loans, ranging from 7% to 7.5, I believe, sir.
So what you need to do is, in that context, look at what I said. Make an adjustment of the property value based on what you are paying as rent and get something. So that means you might have to get a smaller house. That's all right. You're buying it for yourself.
Okay, you are requesting us to take whatever the affordability should be in your thing.
Absolutely. That's the bottom line. Yes. So I am paying for my house less than what I would pay for rent.
Okay.
Okay. Any other questions?
So good morning, sir.
Okay then. Thank you so much. Yes, Durga, you have one more question.
Yeah, quick, Durga Prasad.
Yes, sir.
Yes.
Sir, how did this the crisis affect the housing market? Post crisis.
Prices went down quite a lot. The lot of prices were affected. So people were just selling off. People were out of jobs. Even same with the COVID crisis. A lot of people out of jobs, and that is affecting the property markets as well. Rental markets in some countries.
So how many years it took to just recover everything?
My guesstimate would be anywhere between 2 to 5 years.
Okay, sir.
Okay. All right. I think that is enough time. You might have to go for another class now, so I will close it there.
Thank you, Prof. Yeah.
Not a problem, Prof. Thank you so much. And I hope you have learned at least something new walking out of this class when you came in. Is that true? Have you learned something today?
Professor. Yes, Professor.
Yes, sir.
Good. That means I have done my job. Okay. Thank you so much.
Prof,
All the best to you, and I'll see you
next week, same time, Prof, 8:30.
Same time. Yes, 8:30 Indian time. India time 8:30. Okay.
We'll be sending